Hey everyone, it's Samples 2. One of the most common questions I get is about building wealth and securing financial freedom. It's not about getting lucky with some meme stock or putting all your eggs in one basket. It's about building a solid, diversified portfolio that can weather any market storm. Today, we're diving deep into portfolio diversification. By diversifying, you're essentially creating a safety net for your money. So, whether you're just starting out or you've been investing for a while, this video is your ultimate guide to mastering portfolio diversification. Stick around because this is the kind of financial advice that can change your life. Alright, let's break down this whole diversification thing. In the simplest terms, portfolio diversification is like having a financial buffet instead of just ordering one dish. You're not putting all your money into just one stock, one bond, or one real estate property. Instead, you're spreading your investments across different asset classes. Think stocks, bonds, real estate, maybe even some gold or commodities. When one asset class is down, another might be up. This helps to balance out your risk. For example, if the stock market takes a hit, having some of your money in bonds, which are generally considered less risky, could help cushion the blow. Diversification is all about not putting all your eggs in one basket. It's about managing risk effectively so you can sleep well at night knowing your investments are working hard for you, even when the market gets bumpy. With a diversified portfolio, you'll be well prepared to ride out those bumps and come out ahead in the long run. Look, I get it. When you hear about a hot stock tip or everyone's jumping on the latest investment trend, it's tempting to go all in. But trust me, that's a recipe for disaster. Diversification is your best defense against the unexpected. It's about protecting your hard-earned money from the inevitable ups and downs of the market. Think of it like this. If you were a construction worker, would you show up to a job site without your hard hat? Of course not. You need that protection in case something falls or goes wrong. Diversification is your financial hard hat. It protects you from the unexpected. When you spread your investments across different asset classes, you're increasing your chances of capturing gains in different areas of the market. By diversifying, you're essentially casting a wider net and increasing your odds of catching a big fish. Diversification isn't just about spreading your money around randomly. It's about doing it strategically and aligning your investments with your individual financial goals, risk tolerance, and time horizon. Diversification is essential for anyone who wants to build long-term wealth and achieve financial freedom. By spreading your investments, you reduce the risk of losing everything if one investment fails. It's a smart strategy that can help you sleep better at night, knowing your financial future is more secure. Alright, we've talked about what portfolio diversification is and why it's so important. Now let's get into the nitty-gritty of how to actually diversify your portfolio. First off, there are different ways to diversify, and it's not just about the number of different investments you have. The key is to diversify across different asset classes. This means having a mix of stocks, bonds, real estate, and maybe even some commodities or alternative investments. Think of it like building a house. You wouldn't just use wood for everything, right? You'd use a combination of materials like concrete for the foundation, wood for the frame, and maybe some metal for the roof. Each material has its own strengths and weaknesses, and together they create a strong and stable structure. The same goes for your portfolio. By diversifying across asset classes, you're creating a more balanced and resilient portfolio that can withstand market fluctuations. You can also diversify within asset classes like investing in different sectors or geographically. Diversification is an ongoing process that requires regular review and adjustments as your financial goals, risk tolerance, and market conditions change. It's not a one-time setup, but a dynamic strategy that evolves over time. Regularly revisiting your portfolio ensures it remains aligned with your objectives and adapts to any changes in the market landscape. Chapter 4: How to Build a Diversified Portfolio. Now let's talk about the fun part, actually building your diversified portfolio. Before you even think about picking stocks or bonds, you need to assess your risk tolerance. This means understanding how much risk you're comfortable taking on in pursuit of potential returns. Once you have a good grasp of your risk tolerance, you can start thinking about your asset allocation. A good rule of thumb is to subtract your age from 100 to determine the percentage of your portfolio that should be allocated to stocks. For example, if you're 30 years old, you might allocate 70% of your portfolio to stocks and the remaining 30% to bonds. But remember, this is just a starting point. Your actual asset allocation will depend on your individual circumstances, financial goals, and risk tolerance. A simpler and more hands-off approach is to invest in low-cost index funds or exchange-traded funds, also known as ETFs. The key here is to keep your costs low and look for funds with low expense ratios. Chapter 5. Portfolio Diversification Examples. Alright, let's make this even more practical with some real-life portfolio diversification examples. These examples will help you understand how to balance your investments to achieve your financial goals. Remember, these are just examples, and your actual portfolio will vary based on your individual needs and goals. It's important to consult with a financial advisor to tailor a strategy that fits your unique situation. Let's say you're a conservative investor who prioritizes capital preservation and wants to minimize risk. This type of investor typically seeks stability and steady returns. A conservative portfolio might allocate 50% to bonds, which are generally considered low-risk investments, 30% to dividend-paying stocks, which provide regular income through dividends, 10% to real estate, offering potential for appreciation and rental income, and 10% to a combination of cash and gold, which can act as a hedge against inflation and market volatility. Now let's say you're a more moderate investor who's comfortable taking on some risk in pursuit of higher returns. This investor seeks a balance between growth and stability. A moderate portfolio might allocate 60% to stocks, which offer growth potential, 25% to bonds, 10% to a combination of real estate and commodities, providing diversification and potential for growth, and 5% to a combination of cash, and maybe even a small allocation to cryptocurrencies, which can offer high returns but come with higher risk. Finally, let's say you're an aggressive investor who's comfortable with higher risk and volatility in exchange for the potential for outsized returns. This type of investor aims for maximum growth. An aggressive portfolio might allocate 80% to stocks, which have the highest growth potential, 10% to a combination of cryptocurrencies and commodities, 5% to bonds, which can provide some stability, and 5% to cash, ensuring liquidity for opportunities or emergencies. These are just examples, and your actual portfolio will depend on your individual circumstances, financial goals, risk tolerance, and time horizon. Always consider seeking professional advice to create a plan that works best for you. Chapter 6. Common Mistakes to Avoid. Okay, we've covered a lot of ground today, but before we wrap things up, I want to talk about some common portfolio diversification mistakes to avoid. One of the biggest mistakes is over-diversification. You might think that having hundreds of different investments is the key to diversification, but that's not necessarily true. Over-diversification can actually dilute your returns and make it harder to track your portfolio. Another common mistake is ignoring costs. Every dollar you pay in fees and commissions is a dollar that's not working for you. Emotional investing is another big one. Stick to your investment plan, don't panic sell when the market dips, and avoid chasing after the latest hot stock tip. And finally, don't forget about rebalancing. Chapter 7. Tools for portfolio diversification. Alright, let's talk about some tools that can help you diversify your portfolio and stay on track with your financial goals. One option is to use a robo-advisor. Robo-advisors are automated investment platforms that use algorithms to create and manage a diversified portfolio for you based on your risk tolerance and financial goals. Some popular robo-advisors include Wealthfront, Betterment, and Acorns. Another option is to use a traditional brokerage platform. Brokerage platforms like Fidelity, Vanguard, and Charles Schwab offer a wide range of investment options, including stocks, bonds, ETFs, and mutual funds. In addition to robo-advisors and brokerage platforms, there are also a number of portfolio trackers that can help you monitor your diversification and performance. No matter which tools you choose, the important thing is to have a system in place for tracking your investments and making sure that you're staying on track with your financial goals. Outro your path to financial freedom starts now. So there you have it, your ultimate guide to mastering portfolio diversification. Remember, diversification is not about eliminating risk entirely. It's about managing risk effectively so you can sleep well at night knowing your investments are working hard for you. The right balance of investments depends on your individual goals, risk tolerance, and investment horizon. Take the time to understand your own needs and goals. And don't be afraid to seek professional advice from a financial advisor. Stay disciplined, review your portfolio regularly, and make adjustments as needed. Diversification is a journey, not a destination. Now, I'm curious, what are your biggest takeaways from this video? What steps are you going to take to diversify your portfolio? Let me know in the comments below.